So for Lance has been patient just about an hour, but Lance has a couple questions here, and I can't tell how in-depth it is, so let's give it a go. Let's go back to the main home tab. Lance, I'm new to trading options. I had a question about one of the weekly picks and how you would have traded it. On Tuesday, the site picked SI 416 165 put. SI 416 165 naked put. You're in the puts, I guess, okay? Stock was trading at 170.20. The next day, the stock fell almost 30 points. How would you have traded it before if you had sold the 165 put before the drop? Okay, and all right. So in this case, now I want to point out, how do I want to start this? I'm going to start it this way, Lance. First, I'm going to go to free webinars, and I'm going to go to options strategies tab in the free webinar section. And we're going to scroll down here in this section, and there it is. From April 27th, 2020. We look at this, in this video, we take a look at potential adjustments on cash secured put that's moving against you. There's one. There's another one further down on managing naked puts. But another concept that you might want to see, I'm sorry, is under options concepts. So April 27th, 2020, Lance, that's one on managing naked puts as well. It's not that I'm trying to avoid your question. I just want to show you these first. Did I skip over it? I didn't. Okay. From 2016, manage your broken position. Alternative methods for managing a stock position that's fallen, a covered call that's moved against you, managing a sold put that is ITM or the stock has been put to you. Okay, so there's some information there, Lance, in the free webinar section, more details than we're going to be able to go into today. Just wanted to point those out. Second thing I wanted to point out is, oh, shoot. All right, everyone hold for 1 second. If I have to go back to this account, I will. Let me pause the screen for a second. I'm sorry. To help me with Austin's research and analysis today, even though sometimes the stocks did move, I changed, I'm sorry. I'm sorry, folks. I changed the webinar account to an end of day account so that I could freeze the prices while doing the analysis in the portfolio. So, apologize for that. I've got to go back to my actual account now for Lance here, and let's go into naked puts. Okay. Back here? Yes, we are. All right, naked puts, weekly picks of the day. So you said on Tuesday, and you found a position for SI. We're going to take a look at that in just a moment. But I want to remind everyone of something. And the weekly picks of the day for naked puts and for covered calls, the testing and trading that Ernie did on these positions was based solely on opening them Monday at 3 p.m. When a customer asked me, hey, can you still get a good return of opening the picks of the day on Wednesday for that Friday's expiration or Thursdays for that Friday expiration, I don't know how they're going to perform. We didn't test that. Okay, Ernie based his testing on Friday and running through a whole bunch of iterations on opening Friday for the next Friday, and then he compared it to Monday for the following Friday, 5 days away. He found out that opening on Monday was the best one. You don't expect too much difference, but in volatile markets, you can expect difference in the results from one day to the next. So my advice is to focus on doing it on Monday rather than a Tuesday or a Wednesday when you're looking at the picks of the day or planning on doing them. Okay, because we know that's how they worked, and we know that they work well. And it was usually opened in the afternoon around 2 or 3 p.m. Eastern time. That's why we have that post there. But let's go to SI. Okay, on Tuesday, the 13th, okay, let's get our chain for Tuesday the 13th for April 16th expiration. Stock is trading at 166.49. Okay, you said 165. I'm going to use the closing prices. 166.49. The out of the money 165 put was shown, and this is about at 610. Okay, so we've got let's look at the puts only, Lance. Okay, let's look at the puts only. All right. So there we go. 610, a potential 3.7% naked yield on the position. And 165, I'll take the midpoint near the close, at the close at 610. Now, go ahead. I hate when I do that. 1 second, folks. I know my screen is not frozen. I have it on hold right now. I'm going to go to the portfolio real quick. Okay. And yeah, we'll put it in here. Short put, Lance. Sell to open, SI. 16th expiration, 165. Keep the math simple. It's 0.10. Okay. Fantastic. So that's in there now. We're at a loss, so expected max return of 610. We're at a loss of 25.65. You know, down pretty far from the expected max profit that we were expecting to see. Of course, let's go to the profit and loss chart. Nah, didn't need the profit and loss chart. I wanted to go here. Sorry about that. Okay. So this was our, let me, oh, that's got to stay in there. Okay. All right, I just wanted to use that so we could see the dates better. So we're talking about opening on Tuesday, the 13th, last day of the good run. And then this happens and we end down here. So let's go to that. Let's go to a 5-day chart. I know you gave me the screencast chart there, but I don't want to risk clicking that in here because I don't know how this system behaves when you try to click a link from someone else in a webinar. I don't think it likes it actually as much. Okay, so we opened it on Tuesday. Somewhere over here. Okay, so 165, right? Yeah, right around in here. So on Tuesday, it dipped down badly, and I'd be in a panic here. I'm sorry. We got in here. My apologies. Read it wrong. Read it completely wrong. Okay, so we would have gotten in around here, possibly, or in the afternoon here. 3 o'clock on a Tuesday for the picks of the day again, but I would have opened it here about the same time, Monday afternoon around 3 o'clock when it's 175. Okay. Market opens, and in the first 2 to 3 hours, it's down to here. Probably here would have been my trigger point to close the position. Actually, I might have closed it here. I wouldn't have rolled it or adjusted. I would have closed it. Why wouldn't I have rolled or adjusted it? Because of what Ernie talks about in that weekly picks of the day field I just showed you. Let's go back. Okay, let's erase the drawings. I'm sorry. Go back to naked put in the weekly picks of the day. And in this field here, he discusses, where's his stop? I'm sorry. I know it's in here somewhere. Okay. Yeah, more speculative than many investors because of high IV. These results are based on exiting the position if the stock drops 7%. So we were in at 165. So when that trigger hit and the stock fell, okay, it was 166.49 when I looked at it on Tuesday's close. When the stock dropped 7% from that value, I just would have bought to close the put, taken the loss, and that's it. The goal of the weekly picks of the day was to have a structure in place that was successful over different time periods that resulted in a strong return. But again, you want to read and make sure you understand all the concepts here that we allow the higher IV because they did perform fairly well. But these are the things that can happen. Based on exiting the position when the stock drops 7%. Having a stop loss to put in them seemed a prudent tactic, okay? So you want to make sure that you would close it at that time. Oh, sorry about that. On Silvergate, when we took that 7% loss on the position. Okay, when the stock fell 7%, and I would have put that in as an alert if I had opened that naked put position. So for my basis of 166.49, be about $11. Yeah, so when I said when it hit right about here, that would have been my trigger. We were looking at it earlier. I said right around it here would have probably been my trigger. That's when the stock's trading around 155, which is $11 off of 166.49, or a little bit more than $11 off, and that's the 7%. Would I have taken a loss? Yes, I absolutely would have taken a loss. We collected 610 on the 165 put. This probably would have been at least $12 or $13, but it's not $25. It's not $23. It's half of that. Okay, we were being the money with 3 days to go. We were about 10 points in the money, and then some implied volatility probably increased in that case. So I probably would have paid $12 to close this position. I would have followed the rules when the trigger hit, closed it at 7%. And it looks like I had some time. You know, it was wavering around this 155 price for about 11 o'clock on Wednesday. It's about 12:15. It looks, maybe not so much 12:15, maybe right around 12 or 11:45. That's what I would have done. Now what can I do is the other question. And that's probably best answered by some of those more in-depth webinars, managing your broken position. Let's take a look. So I didn't do it, and I would have been likely put SI today at 165. My cost basis is 159, 158.90. With the stock, with the stock at 133, okay? So what likely I would have done is gone to SI now, put the stock. I'm going to click on stock repair, Lance, up here at the top. Got our symbol SI. My cost per share is 158.90. We were put the stock at 165 today. We kept the 610 premium. And we'll just use 100 shares, of course. Let's keep the math simple. Are there any stock repairs? Oh, not bad. Not bad at all. So this has fallen down to 133. And we have a May repair. What is this tool doing? It's trying to find me a ratio repair to help me get back to break even faster. I could buy a 130 call, May 130 call for SI, and sell 2 140 straight calls and get a net credit of $9.40. And my break even drops to 139.75. How is that possible? Let's take a look. Okay, so we see here we can buy one May 130 call for $19.80. And we're going to sell 2 May 140 calls for $14.60. So pay $1,980, get $2,920 back. That's my $940 net credit. My cost base is $158.90. How do I have an effective break even of 139? This 940 only puts me down to, 149.50, right? Yeah, 149.50. It's because essentially what the repair does for you is we have a stock position. You're going to buy one call at 130 and sell one at 140. That's a bull call debit spread. And you're going to sell an extra call at 140. So you've got a covered call with a bull call debit spread. You took in 940 of premium, which essentially lowers the cost base, as I mentioned, down to 149.50, roughly. But if the stock's trading at 139.47, here, your 130 call that you received at a credit is worth $9.75. 139.75. We have a loss of $19.15 from our cost basis. We took in a credit of 940. The 2 short calls at 140 expire worthless. My long 130 call is worth 975. I'm at a break even. I don't need the stock to go back to 158.90. I don't need it to go to the 149.50. I just need it to go back to 139.75 on May expiration. That's how it works. Great to see it numerically. Here it is graphically. It's not a great return, I know. But if the stock was at 139.75 and I did nothing with my cost basis of 158.90, we're still at a loss about 20 points. Here, I'd be at break even with this trade. But you see a flaw. Lance, you see the flaw here. This only works. Let's increase this graph here. There we go. This only works if you do expect the stock to come back up and recover. Because what does this repair not do? It doesn't take care of any more of this if SI continued to move down in price. But this is a way that now that I've been put the stock with that short put and I kept that 610 premium, I do have a loss of $25.90. Let's just call it $26. But the stock repair tool gives me something where I only need the stock to go up another $6 or $7 so I can be at a break even while I'm still technically 20 points below my cost basis after being put the stock because it collapsed against me. And even though that looks promising than taking the $600 loss, I would have said by maybe buying to close that option at $12, 11 to 12 o'clock, because it fell to 7% in sort of the guidelines Ernie talks about on that page. I still probably would have closed it honestly in that case, because these are designed not to be long-term holdings, not to continue to roll them and adjust them as you would a more bullish stock like we looked at for Don earlier that has high average stock volume, lower volatility to try to get consistent profits or roll continued naked puts against it. Weekly picks of the day are designed to give us positions for potential strong premium on a consistent basis, but they are more volatile as it's discussed. Yes, these things can happen. So I would have followed the 7% rule because that's how Ernie tested it with his testing and his trading to be profitable over those different market conditions long term. But if you are in a situation like this, you ended up in this position or something similar, take a look at that stock repair tool. See if you've got opportunities to get back to break even faster without doing that.